Welcome back. How do we time a recession? The classic definition of a recession is two consecutive quarters of negative GDP. Or we can consider a recession simply a period of time of very weak stock market performance. There's been about four significant recessions in the past several decades in the late 1980s, in the year 2001, 2008, and then, well, something coming soon. The white histogram bars show us a consecutive number of days the Federal Reserve raised interest rates to a level above those bond yields, like the 1 year in red, the 10-year in green, or the 30-year in purple. Zooming in on where we are now, we see federal funds rate around 5.5%. The 1 year treasury is very close, but it's also below 5.5% at the moment. And then we have the 10-year and 30-year green and purple lines, respectively. We saw a period of time, June of this year, around 90 consecutive days. The federal funds rate was above those bond yields. We had a small break, another 70-day consecutive streak. Well, what does this mean? This occurs when the Federal Reserve raises inflation or raises interest rates to fight inflation. But raising interest rates too much sometimes leads to a recession. What does this look like in terms of history? Well, going from 1988 on to 1990, we saw a very significant period of time. Federal funds was levied up to a point around 9.5% at one point. And then the bond yields began to sink. And that started a very long consecutive streak, about 300 some odd days, where the interest rates, the federal funds interest rates, shown here again in yellow, were above the 1, 10, and 30-year bond yields. And that led to a rather minor recession, relatively speaking. We had the year 2000, 2001, following that very exciting tech bubble, where the Federal Reserve raised interest rates around 6.5%. The bond yields, the 1, 10, and 30-year, were below that for about 250 consecutive days, and that led us to the 2001 recession. Notice, by the way, the consecutive days that the federal funds rate is above the bond yields precedes the recession. So this actually can be a very interesting tool to time the beginning of recessions. We fast forward to 2005 through 2008. We had a very strong economic condition in 2005, 6, very strong stocks, lots of inflation. The Federal Reserve raises interest rates, bond yields go up, but eventually these high interest rates start to slow down the economy. And eventually the bond yields started to fall while interest rates remained high. That lasted for over 300, maybe 325 days. And then everything came to an end 2008, third quarter 2008. Well, fast forward to present day, we had the Federal Reserve that we know famously raised interest rates from a very low point to our current 5.5% level. We had around 90 consecutive days that the Federal Reserve kept interest rates above the highest bond yields, and then a little bit of a break, and now 70 consecutive days that the Federal Reserve has had interest rates above those bond yields. Currently, interest rates at 5.5%. The 1 is very close. The 10 and the 30 are falling behind. So the question to you is that given the fact that prior recessions in 1990, 2001, 2008 lasted between 275 and 325 consecutive days, how many days do you think we will see the Federal Reserve interest rates above our bond yields? When do you think it'll end? What do you think will be the ensuing outcome? It'll be very interesting to see how this works out. We hope this has been helpful. We look forward to seeing you back soon.